Hello friends, today's topic is case laws. In this topic we will be understanding the interpretation of the court of law where there is an ambiguity in the provisions of the act. And here we will be discussing the case laws which are related to the provisions under the head income from other sources. So friends, the first case law which has been held by, it is an apex court ruling in the case of CIT versus Sri Rama Multitech Limited in 2018, 403 ITR 426, Supreme Court. The issue under consideration here is whether the share application money is received by the SSC and it has been deposited in a bank account, interest received on the share application money, whether it can be deducted from share issue expenses, public issue expenses, whether it can be deducted from the same, or it has to be offered as income under the head income from other sources. So friends, interest on share application money, what should be the treatment in the hands of the SSC, whether it is allowed to be deducted against the share issue expenses, or it has to be taxable under the head income from other sources. So SSC over here is trying to claim share issue expenses, is trying to claim a deduction, adjusting the income against the expenses. However, assessing officer here is trying to tax the interest income from share application money. So facts of the case are SSC company is bringing an IPO wherein the company has received profits, the cut start, wherein the company has received proceeds as share application money from the subscribers, and such a share application money has been transferred to a bank account till the allotment of shares. Correct? So as a process, when IPO is paid out, subscribers subscribe to it, and subsequently, if eligible, they are allotted shares, and the amount paid by the subscribers to the company is share application money. Correct? So such a share application money has been transferred by the company to a bank account, and accordingly interest has been earned from such a share application money which is deposited with the bank account. Now here we have to interpret what should be the taxability of such interest income, whether it should be allowed to be deducted, adjusted against the share issue expenses, or whether it should be treated as income under the head income from other sources. Correct? So let's read the issue under consideration and facts of the case. Then we will move on to what are the observations of the apex court in this case and what was held by the apex court. Issue under consideration is the interest income from share application money deposited in a bank eligible for set off against public issue expenses, or should such interest be subject to tax under the head income from other sources. So either set off or taxable under the head income from other sources. Facts of the case: the SSC company came out with an IPO, initial public issue of shares within the relevant assessment years, and deposited the share application money received in banks. The interest earned on the deposits was shown in the return of income originally filed under the head income from other sources. So the SSC has offered to tax the interest income originally under the head income from other sources. Subsequently, the SSC company realized that this income can be set off against the expenses. So at the time of tribunal, an additional ground was proposed, wherein it was contended by the company that such income should be set off against the public issue expenses. Subsequently, the SSC company raised an additional ground before the tribunal for allowing the set off of such interest against the public issue expenses. Correct? So friends, Supreme Court's observations and Supreme Court, what does the Supreme Court held in this case? In this case, what will happen is the amount has been deposited with a bank account, and as per the provisions of the statute, it is a statutory requirement for a company to deposit the share application money in a bank account. So, amount deposited in a bank account by the SSC is out of statutory requirement. The company has to deposit the amount till the allotment of shares in a separate bank account. Correct? And at times, if people are not eligible for the shares, if certain amount of shares are not been allotted, if the subscription is oversubscribed, if the IPO is oversubscribed, then at times share application money received is to be refunded to the SSCs, is to be refunded to the subscribers. So in such a scenario, it is always recommended that a separate bank account is open, and such funds, if a subscriber is not eligible, can be refunded back to the subscriber as soon as possible. So friends, accordingly, a statutory requirement, out of a statutory requirement, a company is required to open a separate bank account and deposit the share application money there. And it depends upon bank to bank who is paying an interest and how much amount of interest has been paid on the share application money. So you can say the intention behind opening a bank account and depositing the share application money is not to earn interest income, but the intention is a statutory requirement for the SSC company to deposit the amount in a bank account. And the intention here is not to earn any interest income. Correct? So it can always be said that such an income should not be taxed under the head income from other sources. This could be one of the contention. And secondly, the issue of share can be said to be in the form of capital structure, or you can say if any expenses are to be capitalized are in capital nature, then income earned from such share application money can also be termed to be in the capital nature, and it cannot be taxed in the hands of the SSC as revenue in nature and under the head income from other sources. So income from share application money, interest income from deposit of share application money can be termed to be capital in nature and accordingly not taxed in the hands of the SSC. Correct? So these were the observations of Supreme Court. The Supreme Court held that such an amount won't be taxable in the hands of the SSC. The SSC company is eligible to set off the amount against the public issue expenses. Correct? And ultimately, if you see, no benefit is being derived by the SSC. Obviously, the tax amount, the interest income is not getting taxed in the hands of the SSC. There is a benefit for the SSC. However, having said that, at times, if certain conditions are satisfied, the public issue expenses are also allowed as deduction to the SSC. Right? So if deduction is reduced, then you can say benefit indirectly has been reduced, where income is adjusted against the public issue expenses, then indirectly we can say even the benefit is reduced for the SSC. So either you reduce a deduction or increase the income. It's one and the same. Deduction of public issue expenses may be allowed under section 35D, amortization of preliminary expenses in the hands of the SSC, wherein public issue expenses may be allowed to the SSC as reduction. So friends, however, Supreme Court was in favor of the SSC in this case, wherein interest received from deposit of share application money is not revenue in nature and can be adjusted against the public issue expenses. The same won't be taxable under the head income from other sources. On your screen, Supreme Court's observations. The apex court observed that the SSC company was statutorily required to keep share application money in a separate account till the allotment of shares was completed. Correct? Part of the share application money would normally have to be returned to the unsuccessful applicants, and therefore the entire share application money would not ultimately be appropriated by the company. So if the IPO is oversubscribed, if I had asked only for 100 rupees and I got 250 rupees, then entire 250, the share application amount will be parked in a separate account, and out of this 150 will be refunded back, as you are no more eligible. As you can see, subscribers are no more eligible post 100 rupees. Correct? So this is what second para which is highlighted is also trying to say. So the entire share application money would not ultimately be appropriated by the company. In an example, 250 rupees entirely would not be part of company's proceeds. Ultimately, only 100 rupees will be part of company's proceeds. The interest earned was expressly linked with the requirement of raising share capital. Any surplus money deposited in the bank Any surplus money deposited in the bank for the purpose of earning interest is liable to be taxed as income from other sources. There is no doubt about it that amount deposited on which interest is earned is taxed as income from other sources. However, having said that, share application money was deposited not out of a surplus money but out of statutory requirement to comply with the statute. The interest accrued on such deposit is mere incidental. So the main intention, as we discussed earlier, the main intention of the SSC is not to earn interest income on the deposit. However, the main intention is what is returned as per statutory requirement. What's the statutory requirement is needed to be adhered to. The statutory requirement is you have to deposit the share application money received in a separate bank account. This is what has been done by the SSC. He has deposited the share application money in the bank account out of statutory requirement, and the main intention is not to earn interest income but to comply with statutory requirement. Moreover, having understood the intention behind the deposit, now whether interest income can be termed as capital in nature was observed by Supreme Court. Moreover, the issue of shares relates to capital structure of the company, and hence expenses incurred in connection with the issue of shares are to be capitalized. Since interest income is from issue of shares which relates to capital structure of the company, it can be said that it is in connection with issue of shares which are to be capitalized. Accordingly, accrued interest is not liable to tax as income from other sources. The same is eligible to set off against public issue expenses. Supreme Court's decision in this case, the apex court concurred with the High Court's view, agreed with the High Court's view that the interest accrued on deposit of share application money, that the interest accrued on share application money is eligible for set off against the public issue expenses. Such interest is hence not taxable under the head income from other sources. So the Supreme Court held in favor of the SSC, wherein interest expenses, interest income earned from share application money was allowed to be set off against the public issue expenses, as held by the apex court in the case of CIT versus Sri Rama Multitech Limited. So friends, this concludes this case law. Now friends, the next case law is CIT versus Parle Plastics Limited, which was held by Bombay High Court. In this case friends, the issue under consideration is the substantial part of the business of the lending company. What should be a substantial part of the business? I mean, what are the tests to determine what is the substantial part of the business of the lending company? Meaning, it is coming from section 2, clause 22, subclause E, 222E, wherein advance or loan provided to shareholder who is having a substantial interest in a company, right? If any payment is made out of accumulated profits, then in such a case, the amount so paid, in such a case, the amount so paid to such a shareholder or for the benefit of such a shareholder will be deemed dividend, correct? And in this, there is an exception wherein if the business of the SSC, if the business of the company is lending loans, is providing loans and advances, then in such a case, deemed dividend, there will be no taxability of deemed dividend, correct? Now, friends, in this, the sentence reads as where the lending of money is a substantial part of the business of the company, where the lending of money is a substantial part of the business of the company. In such a case, any loans and advances, any advance or loan provided by a private limited company to the shareholder won't be termed as dividend, correct? So the issue under consideration over here is what factors decides what is substantial part of the business, on what basis it is concluded that this portion of the business is substantial part of the business. So friends, in this case, the facts of the case are the lending company has provided loans. Okay, the company is into lending business, and here certain amount is also provided as loan to the shareholder who has substantial interest in the company. So whether such loan amount should be taxable as deemed dividend in the hands of the company or not is the question, right? So the Bombay High Court observed that the factors that should be considered for determining substantial part of the business are the percentage of turnover, the percentage of profit, the percentage of capital employed, and also the correlation between turnover and profit. Meaning, coming to the first part, percentage of turnover, meaning how much contribution is made by the interest income earned. I mean, the company is into lending business, and from that lending, they are earning interest, correct? So, what is the percentage of earning interest vis-a-vis the total turnover of the company? If it is substantial, substantial meaning there is no percentage as such, but however, you can determine that the major portion is earned from the interest income, at least that you can conclude, right? And substantial part, there is no percentage determined as such. However, if generally it is more than 30-35%, wherein if such an interest income is not calculated in the total turnover, then it may be possible that the company is not earning at all, correct? So that's why the importance of earning interest income in the total turnover, if it is substantial, then company will be said to be into the lending business. So based on turnover factor, it is cut start. So based on turnover factor, it may be possible to determine substantial part of the business of the company. Second could be profit factor, wherein the profit earned from the interest income is substantial when compared to profit earned by other activities. Then it can be said that the company's substantial part of the business is into lending business, correct? Then capital employed. If capital employed through lending business, I mean the loans and advances would be assets of the company. If such assets are more as compared to the total assets, they have a substantial part, then the company may be termed as, then the company may be said that it is into lending business. Substantial part of the business is lending business, correct? And correlation between profit and turnover, it may be possible that interest which is contributing to the turnover may be able to earn lesser profit or more profit, and at times this could also be a deciding factor in determining whether the company is earning, whether company's business is from lending business or not. So At times, correlation between profit and turnover is also critical, friends. And in this case, in this particular case, Bombay High Court held that the company was into lending business because almost 40%, 40 to 42% of the assets were from loans and advances, and also interest income earned from loans and advances, it was substantial part, meaning if such interest income is neglected, is not counted in the total turnover, then the total turnover of the company will be negligible, and also as far as profits are concerned, the company will run into losses. So friends, interest income is a substantial part of turnover. Also, if the interest income is neglected, then the turnover will be negligible. Also, friends, the profit, if interest income is not counted in turnover, then the profit will be nil. In fact, the company will run into losses. So, as per the facts of the case, the High Court concluded that company is in the lending business, and not only in the lending business but the substantial part of the company is providing loans and advances, correct? So any advance or loan in such a case provided to the shareholder was not termed as deemed dividend, and accordingly section 222E wasn't applicable, and amount paid by the company to the shareholder was not taxable as deemed dividend, friends. On your screen, Bombay High Court, CIT versus Parle Plastics Limited 2011 332 ITR 63, issue under consideration. Exclusion provision under section 222. What are the tests for determining substantial part of business of the lending company? High Court's observations under section 222, dividend does not include, amongst other things, any advance or loan made to a shareholder by a company in the ordinary course of business. So dividend, deemed dividend is excluded where advancing money is the ordinary course of its business of the company, and the lending of money is a substantial part of the business of the company. So friends, substantial part, the word substantial part, how do you determine, has been laid down in this particular case law. Sometimes a portion which contributes a substantial part of the turnover, though it contributes a relatively small portion of the profit, would be termed as a substantial part of the business. Correct? So friends, correlation between turnover and profit, though it may be possible that interest income is contributing highly to the turnover. Interest income may be contributing highly to the turnover. However, profit generated from such interest income is very low. Even in such a case, it could be concluded that substantial part of the business of the company is lending business. Correct? Similarly, a portion which is relatively smaller as compared to the total turnover but generates a large portion of profit, say more than 50% of the total profit of the company, would also be a substantial part of its business. So friends, it is vice versa, wherein interest income may be contributing relatively lower to the turnover, but it may be possible that it is contributing highly to the profits of the company. Even in such a case, it could be concluded that lending money is the substantial part of the business of the company. Correct, friends? So, friends, first pointer discussed over here is a correlation between turnover and profit. Correct? Now, friend, percentage of turnover in relation to the whole, as also the percentage of profit in relation to the whole, and sometimes even percentage of manpower used for a particular part of the business in relation to the total manpower or workforce of the company would be required to be taken into consideration for determining substantial part of the business. So friends, the factors that we had discussed, first is percentage of turnover, second is percentage of profit, and also manpower percentage is also to be considered, friends, for determining substantial part of the business. Correct? Also, the capital employed. The capital employed for a specific division of a company in comparison to total capital employed would also be relevant to determine whether the part of the business constitutes a substantial part or not. Correct? So, capital employed is also to be considered apart from manpower, profit, turnover, and correlation between turnover and profit. Correct, friends? So, these are the factors which has been laid down by the Bombay High Court in the case of CIT versus Parle Plastics Limited, wherein how do you determine whether lending money is a substantial part of the business of the company or not? Based on this factor, you can conclude that indeed lending money is a substantial part of the business of the company or not, and accordingly, you can conclude that whether advance of money paid by the private limited company to the shareholder who has substantial interest in the company can be termed as deemed dividend or not, can be termed as deemed dividend under section 222E or not. Correct, friends? And in this particular case, as we had discussed, 42% of the total assets of the lending company were deployed by it by way of loans and advances. Correct? So substantial part based on capital employed. Correct? So capital employed factor has been used over here. Also, the income earned, the turnover factor. Further, if the income earned by way of interest is excluded, the other business has resulted in a net loss. So not only the turnover factor, but also the correlation between turnover and profit factor has been used over here. Correct, friends? So, wherein income, if it is excluded from the total turnover, then company will run into losses. Else, if interest income is included, then there will be profit reflecting under the profit and loss account of the company. Correct, friends? These factors were considered in concluding that lending of money was a substantial part of the business of the company. High Court's decision: since lending of money was a substantial part of the business of the company, the money given by it by way of loan or advance to the SSC, to the shareholder, could not be regarded as dividend. So, friends, the High Court, the SSC, held in favor of Parle Plastics Limited, wherein Parle Plastics Limited were into the business of lending money, wherein lending money was held to be substantial part of the business of the company, and accordingly advance or loan paid to the shareholder wasn't termed as deemed dividend. So friends, even if, let's take an example that the company is not originally into lending of money, right? However, it can be said that substantial part, I mean 30-40% you can say, substantial part of the business of the company is lending money, then it can be concluded that deemed dividend 222E is not applicable to the company, and in favor of the case law, I mean in favor of the SSC, Bombay High Court ruling of Parle Plastics Limited can be referred to. Correct, friends? So friends, this concludes this case law. Now friends, in next case law, which is again a Bombay High Court ruling in the case of CIT versus Veer Vikram Ved 2014 367 ITR 365. And the issue under consideration here is that substantial repair and renovation expenses has been incurred by the concerned company, and the property which has been repaired, which has been renovated, is the property of the shareholder of the company. The shareholder is executive director of the company and is also holding 75% of the shares of the company. So in such a case where a rental income is received by the executive director, by the shareholder of the company in such a case, and the rent is paid by the company itself. So friends, the relation between the shareholder, which is the executive director in this case, the relation between shareholder and the company is that of owner and tenant, right? Wherein the rental expenses are paid by the company to the shareholder, and keeping that aside, before using the property for the purpose of business or profession, the company has repaired and renovated that particular property which belonged to shareholder. So whether repair and renovation expenses incurred by the company would be termed as deemed dividend under section 222E or not is the issue under consideration in this case. Correct, friends? And to further go into the facts of the case, the executive director was using this property previously for his own business or profession. Correct? However, after few years of using the asset and finding no success in the proprietorship concern, I mean in the business, he didn't achieve any success. That's why the property which was held by the executive director, which was held by the shareholder, was vacant. And thereafter, once he became shareholder of the company, he allotted this property to the company. I mean, this property was provided on rent, and the condition was substantial repair and renovation was to be incurred by the company for the purpose of using of business of the company. Substantial renovation was required, and substantial renovation was to the extent of 2.51 crores. So the issue under consideration, as we have discussed, is whether this 2.51 crore incurred as repair and renovation expenses by the company can be termed as deemed dividend or not is the issue under consideration, and the assessing officer has taxed this amount in the hands of the company as deemed dividend under section 222E. On the screen, we will understand first what is the issue and the facts of the case in detail. On your screen, issue under consideration: can repair and renovation expenses incurred by a company in respect of premises leased out by a shareholder having substantial interest in the company be treated as deemed dividend or not? Correct? So friends, repair and renovation expenses incurred by the company, whether that amount can be termed as deemed dividend or not is the issue under consideration. Facts of the case: the SSC holds more than 75% of the equity shares in a company and is the executive director of the company. In his personal capacity, he is the owner of certain premises in which he was carrying on a proprietary business. However, subsequently, the SSC ceased to carry on the business of proprietary concern and hence let out the premises to the company. Fine. The SSC, previously the shareholder, the executive director was using for his own business. However, subsequently, since the business is not in existence, the same was leased out to the company. Right? This is what I have highlighted. And friends, the SSC in this case is Veer Vikram Ved, which is the shareholder, or you can say the shareholder or the executive director of the company. So this case law is between CIT versus Veer Vikram Ved, which is the shareholder. And the point to be noted over here is the case law was held in 2014. Previously, what used to happen was this dividend amount was used to be taxable in the hands of the shareholder. Correct? And now the law has changed, wherein concept of dividend distribution tax has come into existence, wherein 222E, friends, dividend distribution tax is applicable and company is required to pay taxes on such advance or loan taken by the shareholder. So previously the amount was taxable in the hands of shareholder. Now the current law, which is till financial year till previous year 1920, thereafter the law has changed again. However, for your syllabus, till previous year 1920, dividend distribution tax is applicable, and accordingly tax on such advance or loan given by the company to the shareholder will be taxed in the hands of the company. Accordingly, this case law will find reference that dividend is taxable in the hands of the shareholder. However, ultimately it doesn't matter because company also is being taxed in this case. So either you refer to the shareholder or to the company, but the basic structure that whether deemed dividend in cut start, whether deemed dividend is indeed applicable or not is to be determined, and accordingly if it is applicable, then previously it used to be taxable in the hands of shareholder. Now till previous year 1920 the same is taxable in the hands of the company as dividend distribution tax. Correct, friends? So accordingly the appellant in this case is Veer Vikram Ved, who is the shareholder, and we have to determine whether the same is taxable in his hands or not. Deemed dividend is taxable under section 222E in the hands of the shareholder or not. Correct? So he was holding more than 75% of the equity shares of the company, and he has leased out a property, one of his premises, to the company for the purpose of business of the company. The company incurred 2.51 crores towards construction and improvement of factory premises, which it continued to use otherwise than as the owner of the premises. So assessing officer's concern was that in spite of incurring such a huge amount as repairs and renovation expenses, the company is yet not the owner of the premises and the company is paying rent to the SSC, which is Veer Vikram Ved. Correct, friends? So AO held that the amount spent by the company towards repair and renovation is taxable as deemed dividend. In the alternative, the said amount was to be treated as perquisite taxable in the hands of the SSC. So either you treat it as deemed dividend in the hands of the shareholder or alternatively treat it as a perquisite taxable in the hands of the SSC, meaning the company, in spite of incurring 2.51 crores as repair and renovation expenses, was not the owner, and all such benefit was flowing to the owner of the premises. Accordingly, such expenditure incurred by the company, which is 2.51 crores, as part of substantial renovation of the property, as per AO's contention, should be taxed as deemed dividend or should be taxed as perquisite in the hands of the shareholder. Correct? Now, what the appellate authorities have held in the case of Commissioner appeal was against the SSC, was against the shareholder, wherein the Commissioner appeals has held that SSC failed to substantiate that the rent amount, that the rental income received was at par with the market value or not. So Commissioner appeals, friends, in this case has held related to the rental income earned by the company and nothing in relation to the repairs and renovation. So Commissioner appeals was from the angle that the rental income earned by the SSC is not as per prevailing market rate, and the SSC wasn't able to substantiate that the same is not at market value. So the Commissioner appeals has held the issue related to the rental income and related to repairs and renovation. The Commissioner appeals was silent. And in the case of tribunal, in the case of Bombay ITAT, it was held in favor of SSC, wherein the repairs and renovation expenses was held neither to be deemed dividend nor perquisite in the hands of the SSC. So friends, Bombay ITAT was in favor of the SSC. Commissioner appeals was not in favor of SSC. Correct? On your screen, the Commissioner appeals noted the SSC's submission that he had leased out the said premises for a rent lower than the market rate with an understanding that all expenditure for its upkeep and maintenance would be spent by the company. Accordingly, Commissioner appeals, the SSC failed to substantiate his claim. The Commissioner appeals was of the view that the conditions provided under section 222E for deemed dividend were satisfied. On the other hand, Tribunal concluded that the payment was neither a deemed dividend nor a perquisite chargeable to tax. So Commissioner Appeals was not in favor of the SSC, wherein based on the submission provided by the SSC, it concluded that the rental income received by the SSC was not as per prevailing market rate, only because, and the reason as per submission is, all the maintenance expenses related to the property, all the renovation expenses related to the property will be taken care by the company, and accordingly he is allotting the property at a lower rent than the prevailing market rate. However, Commissioner Appeals held that the SSC is not able to substantiate this claim further, and accordingly repairs and renovation expenses incurred by the company was termed as deemed dividend under section 222E, and accordingly taxable in the hands of the shareholder. Correct? However, tribunal held that it is neither a perquisite nor a deemed dividend. Correct? And what were the High Court's observations in this case? High Court observed that there was no money directly paid to the shareholder in this case. The company has incurred expenses of repair and renovation for the on the property. Correct? However, there is no direct payment to the SSC. This was the first observation of the High Court. Also, what they held that there is no doubt that the company is using the property for the purpose of rent, and the relation between the shareholder and the company is that of owner and a tenant. Correct? There is no doubt about it, and there is no denying the fact. And they have entered into such a transaction purely based on owner and tenant relationship. Okay, so High Court's observations in this case was, friends, first, there is no direct payment of the loan or advance to the SSC, to the shareholder by the company. Second, they have entered into a genuine relationship of owner and tenant, wherein shareholder has leased out the property to the company solely based on owner and tenant relationship. And based on above, High Court observed that it cannot be said that an indirect benefit has gone to the SSC shareholder. So this was High Court's observations, and accordingly based on this observation, High Court held that any repair and renovation expenses which has been incurred by the company as a tenant won't be termed as deemed dividend under section 222E, and accordingly nothing was held to be taxable in the hands of shareholder. Correct, friends? So Veer Vikram Ved, Bombay High Court in the case of CIT versus Veer Vikram Ved 2014 was held in the favor of the SSC shareholder, wherein repairs and renovation expenses incurred by the company was held not to be termed as deemed dividend under section 222E. On your screen, friends, the High Court observed that no money had been paid by way of advance or loan to the shareholder who has substantial interest in the company. So no direct money was paid to the SSC shareholder. Further, there is no dispute that the company had taken on rent the aforesaid premises. Accordingly, it cannot be treated as payment by the company on behalf of the shareholder or the individual benefit of such shareholder. Correct? Accordingly, High Court held that repair and renovation expenses in respect of premises owned by the SSC and occupied by the company cannot be treated as deemed dividend, and accordingly it was held in favor of the SSC. Correct? So such repair and renovation expenses incurred by the company wherein premises has been leased out to the company, in such a case it will be a genuine owner and tenant transaction between the shareholder and the company, and such repair and renovation expenses cannot be termed as advance or loan provided by the company to the shareholder, and nothing will be taxable as deemed dividend under section 222E in the case of SSC shareholder, neither in the case of the company. So friends, this concludes this case law. Now friends, in next case law, which is Kolkata High Court ruling in the case of Pradeep Kumar Malhotra versus CIT 2011, 338 ITR 538, Kolkata High Court. Friends, in this case, the issue under consideration is related to section 222E only, wherein shareholder and company, two parties are involved. The company, in this case, the company needed loan from the bank, correct? However, the bank asked for a security deposit or a property which will serve as a collateral on the loan provided to the company. So in this case, shareholder came into the picture. He provided his own property to the bank as a security deposit, and thereafter the bank provided loan to the company. So friends, company was able to obtain loan in this case only after the shareholder provided his own asset as mortgage to the bank. Correct? So these were the facts of the case. And now what has happened is, after 2 to 3 years, when the SSE wanted his own property back from the bank, the shareholder approached the company saying that you repay the loan and then I can obtain my property back. However, the company defaulted in making the loan payments, and in this case, in order that company continues to enjoy the benefit of the loan from the bank, and since the company wasn't able to repay the loan instantly, I mean the company was able to pay the EMIs, however the company wasn't able to pay the entire loan amount instantly, the shareholder wasn't able to get his property back. In such a case, he asked the company to pay him a certain portion against the property which has been mortgaged to the bank. So in this case, friends, shareholder has asked for certain amount from the company in place of the property which has been mortgaged with the bank. And the issue under consideration over here is whether such advance or loan provided by the company to the shareholder can be termed as deemed dividend under section 222E or not, wherein such advance or loan has been provided by the company to the shareholder only because the shareholder has mortgaged his own property to the bank. Correct? So the issue under consideration is advance or loan provided by the company to the shareholder in such a case can be termed as deemed dividend under section 222E or not. And here, since the case law is of 2011, accordingly at that point of time, such deemed dividend was taxable in the hands of shareholder. Correct? And accordingly, the name of the case law is Pradeep Kumar Malhotra versus CIT. Correct? So friends, to go further into the case, I mean to understand further the provisions of section 222E, wherein a advance or loan is termed as deemed dividend in the hands of the shareholder only when one-way benefit is obtained by the shareholder. Correct? So section 222E is applicable wherein a company is paying out of its accumulated profits, the company is paying advance or loan to the shareholder, and in return nothing is obtained by the company. Accordingly, such a payment by the company is termed as deemed dividend. Correct, friends? But in this case, you will see that the shareholder has already provided his property to the bank as mortgage, and thereafter he is asking for advance or loan. So there is no one-way benefit. There are two transactions involved over here. In one transaction, the property has been mortgaged with loan, and in response to that property, in lieu of that property, the SSC shareholder is asking for advance or loan. So there is no one-way benefit over here, meaning there is no gratuitous payment by the company to the shareholder. Correct? So the basic premise of section 222E is not fulfilled over here, wherein you can say no gratuitous benefit is going to the shareholder. The shareholder is receiving the advance or loan only because a property, his own property is mortgaged with the bank. Correct? So, High Court's observation in this case was, in absence of gratuitous benefit to the shareholder, such advance or loan by the company to the shareholder will not be termed as deemed dividend under section 222E. Correct? So Kolkata High Court in this case was in favor of Pradeep Kumar Malhotra. On your screen, issue under consideration whether the advance given by the company to the SSC shareholder by way of security deposit for keeping his property as mortgage on behalf of the company can be treated as deemed dividend within the meaning of 222E. So shareholders' property was mortgaged on behalf of the company. In lieu of the property mortgaged, security deposit was demanded by the SSC shareholder. Facts of the case: in the present case, the SSC shareholder holding substantial voting power in the company permitted his property to be mortgaged to the bank for enabling the company to take the benefit of loan. Correct? The shareholder requested the company to release the property from the mortgage. On failing to do so and for retaining the benefit of loan availed from the bank, the company gave advance to the SSC, which was authorized by resolution passed by Board of Directors. So on failing to release the property from the mortgage, company has provided advance to the SSC. Kolkata High Court's observations: the phrase by way of advance or loan appearing in section 222E must be construed to mean those advances or loans which a shareholder enjoys simply on account of being a person who is beneficial owner of shares, meaning he is able to influence the company to provide him a loan, right? So shareholder enjoys simply on account of being a person who is the beneficial owner of shares, holding not less than 10% of the voting power. In case such loan or advance is given to such shareholder as a consequence of any further consideration which is beneficial to the company received from such shareholder, such advance or loan cannot be said to be deemed dividend. Correct, friends? So in such a scenario, there is no one-way benefit to the shareholder. He is not influencing the company to pay him advance out of his beneficial ownership, out of his substantial interest. However, he is asking company to pay the amount only because his own property, shareholder's own property, is mortgaged with the bank, and such a bank has provided loan to the company on the basis of the property mortgage. So in such a case, loan or advance is given to shareholder as a consequence of any further consideration which is beneficial to the company, which has been received from the shareholder. And accordingly, such advance or loan cannot be termed as deemed dividend as per the income tax provisions. So friends, High Court's decision in this case: gratuitous loan or advance given by the company to a shareholder who is the beneficial owner of shares would come within the purview of section 222E, but not to the cases where the loan or advances are given in return to an advantage conferred upon the company by such shareholder, since the benefit was already accruing to the company, and in response to that benefit the company has provided loan or advance to the shareholder, to the SSC shareholder. Accordingly, such advance or loan by the company to the SSC shareholder won't be termed as deemed dividend under section 222E. Correct, friends? Accordingly, Kolkata High Court was in favor of Pradeep Kumar Malhotra, was in favor of the SSC shareholder in the case of Pradeep Kumar Malhotra versus CIT. Friends, again, I would like to reiterate that current provisions of previous year 1920 taxability of deemed dividend under section 222E is in the hands of the company and the company pays dividend distribution tax. Earlier, there was a provision wherein deemed dividend under Section 222E was taxable in the hands of shareholders. Accordingly, you have seen several case laws now wherein a particular transaction falls under deemed dividend under Section 222E or not is the situation, and such amount are being taxed in the hands of shareholder. Correct? Because this was as per earlier provisions. Now the provision is that such deemed dividend is taxable in the hands of the company. And accordingly, the basic premise of whether indeed a transaction is deemed dividend under Section 222E or not, that basic premise remains common. Whether it will be taxable in the hands of the shareholders or in the hands of the company is a separate part. You can say it could be irrelevant. First, determine whether a particular transaction is deemed dividend under Section 222E or not. And once it is held and once it is determined that such a particular transaction is taxable as deemed dividend, then in whose hands the same is taxable, and the current provisions of previous year 1920 for your syllabus, the taxability is in the hands of the company. Correct? So in this case, Kolkata High Court was in favor of Pradeep Kumar Malhotra, wherein advance or loan provided by the company was held not to be deemed dividend only because there was no one-way benefit, there was no gratuitous benefit in the hands of the shareholder. Previously, the shareholder had mortgaged his own property for the benefit of the company, and accordingly, any loan or advance against such a property, any security deposit to the SSC shareholder will not be termed as deemed dividend under Section 222E. Correct, friends? Now, the next case law. Next case law is Delhi High Court ruling in the case of CIT versus Ambassador Travels Private Limited. Here, the issue under consideration is where there are trade advances, where there are financial transactions in the normal course of the business of the SSC, then in such a case, whether payment or transactions between sister concerns in the normal course of business of the SSC can be termed as deemed dividend or not is the issue under consideration. The facts of the case are Ambassador Travels Private Limited was into ticket booking business. It is into travel agency business wherein it books ticket in a hotel accommodation, or you can say develops travel packages for its customers. And in this case, the customers are the clients of the concern who has substantial holding in the SSC. So the travel agency company, which is the SSC, is booking resorts on behalf of the clients of his two concern. Correct? So whether such a financial transaction will be termed as deemed dividend under Section 222E or not is the issue under consideration. Again, the facts of the case are SSC is a travel agency. It is booking tickets. It has booked resorts on behalf of the clients, on behalf of the customers of the two concern, customers of a sister concern, and such a concern has substantial interest in the company. Correct? So friends, such a financial transaction can be said to be a trade advance or not is the issue under consideration. You would have recalled, friends, that we have discussed initially that CBDT clarification has been issued. CBDT circular in 2017 has been issued wherein they have consolidated all the relevant case laws in favor of the SSC, wherein trade advances are not termed as deemed dividend. Correct? So Ambassador Travels Limited was one of the case law. wherein trade advances are not termed as deemed dividend. Correct? So, based on that circular, which was issued by CBDT in the year 2017, circular number 19 2017, trade advances are not deemed dividend, and accordingly, based on that line, you can sense that based on that line, trade advances cannot be termed as deemed dividend under section 222E. So this case law also, Delhi High Court case law, is in favor of the Ambassador Travels Private Limited, wherein such a transaction between two sister concern cannot be termed as deemed dividend, only because such a financial transaction are in the normal course of the business of the SSC. Correct? So issue under consideration, would the provisions of deemed dividend be attracted in respect of financial transactions entered into the normal course of the business of the SSC? The SSC, a travel agency, has regular business dealings in with two concerns in the tourism industry dealing with holiday resorts. Correct? The SSC was involved in booking of resorts for the customers of these companies and entered into normal business transaction as part of its day-to-day business activity. So, as part of travel agency, it has booked tickets for the customers of the sister concern. Correct? So, friends, the financial transaction, as you can see, is in relation to the normal course of business of the SSC, wherein the SSC has booked tickets for the customers of the sister concern. High Court's observations and decision under Section 222E, loans and advances made out of accumulated profits of a company in which public are not substantially interested to a beneficial owner of shares holding not less than 10%, or to a concern in which such shareholder has substantial interest, is deemed as dividend. These are the provisions of Section 222E. However, this provision would not apply in case of an advance made in the course of business, SSC's business as a trading transaction. However, 222 won't apply in the case of advance in the course of SSC's business as a trading transaction. Correct? The High Court observed that the SSC was involved in booking of resorts for the customers of these companies and entered into normal business transactions as part of its day-to-day business activities. The High Court therefore held that such financial transactions cannot under any circumstances be treated as loans or advances received by the SSC from these concerns for the purpose of application of Section 222E. So friends, since tickets were booked on behalf of the clients of the two concerns, and only thereafter such a concern has paid back the amount to the SSC. So this is nothing but a normal business transaction only, and accordingly Ambassador Travels Private Limited, which is into the business of travel agency, such payment received from the two concerns, right? Such payment received from the two concerns, which is purely due to normal business of the SSC, which is purely day-to-day business of the SSC. In such a case, such payment received from the two concerns won't be treated as deemed dividend under Section 222E. Accordingly, the High Court held that such financial transactions cannot be treated as loans or advances received by the SSC from these concerns for the purpose of application of Section 222E. So friends, Delhi High Court was in favor of the SSC, wherein such financial transactions which are in the normal course of the business of the SSC cannot be termed as deemed dividend under Section 222E. This was held by Delhi High Court, and you can say which is in line with the circular issued by CBDT in 2017. Correct? So friends, this concludes this case law. Now friends, the next case law, which is Supreme Court case law in the case of Coppal and Sons HUF versus CIT 2017 391 ITR 1 Supreme Court. In this, the issue under consideration is whether loan provided to HUF by the company can be termed as deemed dividend under section 222E, where the Karta of the HUF is the shareholder of the company. So friends, three people are involved, three persons are involved. Company is providing loan to HUF and Karta of the HUF is holding shares, has a substantial interest in the company. Correct, friends? And in this particular case, friends, I would like to mention that Karta of the HUF, who is the shareholder, there is an ambiguity in it, wherein whether the shareholder is an HUF, whether the shareholder is a HUF or Karta of the HUF is the shareholder, there has been different sources of information. There is ambiguity who is the exact shareholder. However, the loan has been provided to the HUF, that is confirmed, and the HUF, either HUF or either the Karta of HUF, either both of them are shareholder in the company. Accordingly, we have to derive whether deemed dividend implication under section 222E is applicable or not. Correct, friends? On your screen, issue under consideration is loan to HUF who is a shareholder in a closely held company chargeable to tax as deemed dividend under section 222E. The SSE is a HUF which holds 37.12 shares in Messrs. GS Fertilizers Private Limited, a closely held company. So here HUF is holding 37.12 shares. Correct? And the ambiguity regarding to whom the shares have been allotted will come in subsequent slides. During the relevant previous year, HUF received loans and advances from the company. Its return was scrutinized by the assessing officer who treated the same as deemed dividend, who treated the loans and advances as deemed dividend under section 222E. The company declared in its annual return that the advances were given to HUF, but the share certificates were issued in the name of HUF's Karta. So friends, here is the ambiguity wherein the HUF is claiming that Karta of the HUF holds shares in the company and not HUF. Accordingly, loan provided to HUF should not be considered as deemed dividend under section 222E. Correct? So this is the contention of the company, and contention of the assessing officer is that such advance or loan provided to HUF will be deemed dividend under section 222E because HUF holds substantial interest in a closely held company. Correct, friends? However, there is ambiguity on who is holding shares of the company, whether it is Karta or whether it is HUF. Now, friends, appellate authority views. Commissioner appeals was with assessing officer, wherein Commissioner appeals held that dividend income, deemed dividend income is indeed there. Applicability of section 222E is indeed there, wherein advance or loan provided to HUF is a deemed dividend. Tribunal, however, observed that since HUF is not the shareholder, since Karta is the shareholder of the company and loan has been provided to HUF, accordingly, there is no applicability of deemed dividend as per tribunal. Correct? And as per High Court, what they did was they restored the order of the assessing officer. They went against the contention of the SSC, wherein they held that Karta and HUF both are linked. It's like HUF can be included in the terms of relative. Karta can be included in terms of relative of HUF. They both are interrelated, and accordingly loan provided to HUF, even if Karta holds the shares, it will be assumed that there is applicability of deemed dividend. Accordingly, High Court was in favor of the assessing officer, was in favor of the department. So friends, assessing officer went against the SSC, Commissioner appeals went against the SSC, only tribunal was in favor of the SSC, saying that HUF, since HUF is not the shareholder, deemed dividend cannot be made applicable, right? And High Court was again against the SSC, correct? Now we are in front of Supreme Court. In this case, the apex court observed that whether shareholder is Karta or HUF, it doesn't matter. Only because if loan is provided to HUF, even if shares are not held by the HUF, however, the same are held by Karta. Karta and HUF are interrelated, meaning loan has been provided for the benefit of the shareholder, in which, again I will reframe it, loan has been provided to a concern in which shareholder has substantial interest. So friends, provisions of 222E are applicable when advance or loan is provided, wherein advance or loan is provided to the shareholder having a substantial interest, or advance or loan has been provided to a concern in which entity or concern in which the shareholder has substantial interest. Correct? So, common interest. The shareholder, if has a common interest in both the entities, in both the concern, then deemed dividend 222E will be applicable, right? So, in this case, as per the provisions of 222E, explanation 3, HUF is covered under the definition of concern, right? So, accordingly, if we are saying that Karta of the HUF is the shareholder who has a substantial interest, which is 37.12 in the company, and such company is providing loan to a concern, which is HUF in this case, then such a loan provided to HUF will be deemed dividend under section 222E. Correct? So, Karta and HUF are interlinked, and accordingly loan to HUF will be deemed dividend under section 222E. This was held by the Supreme Court, which is in line with High Court observation. Correct? So friends, Supreme Court was against the SSC, was against the contention of the SSC, and accordingly loan provided to HUF was deemed to be dividend under section 222E. Correct? On your screen, appellate authorities' views. Commissioner Appeals confirmed the order of the assessing officer. The tribunal, however, observed that since HUF cannot be registered or beneficial shareholder of a company, the amount cannot be taxed as deemed dividend. The High Court restored the order of assessing officer by observing that the SSC did not dispute that the Karta is a member of HUF which has taken the loan from the company. Correct, friends? So, High Court has linked Karta and HUF. Tribunal has said that since HUF is not a registered shareholder, loan provided to HUF cannot be deemed dividend. Correct, friends? So, Commissioner Appeals was with assessing officer, Tribunal was with SSC, however, High Court was against the SSC. Therefore, the case is covered by section 222E as held by the High Court. Now, what were the observations of the Supreme Court? When a loan is given by a closely held company, it is chargeable to tax as deemed dividend. So these are the provisions of 222E. If the loan was given to a shareholder having more than 10% of the shares in a company, or to a concern in which shareholder has substantial interest, having more than 20% share in the concern here includes HUF as per explanation 3 to section 222E. In the instant case, loans were given to HUF. There was some dispute as to who was the shareholder, Karta or the HUF, as share certificates were issued in the name of the former, but the annual return mentioned the later. Correct? The court observed that in either scenario in a way, whether Karta is the shareholder or HUF is the shareholder, it doesn't matter. the court observed that in either scenario, Section 222E would be applicable. If the HUF was the shareholder, as it held more than 10% shares, situation was covered. There is a direct correlation, right? If the Karta was the HUF, if the Karta was the shareholder, in this case, the HUF would be a concern in which Karta has substantial interest. So friends, link between Karta and HUF, and also it has been specifically covered as explanation 3 that HUF is a concern, and if any money is borrowed, any advance or loan is provided to such a concern in which shareholder has substantial interest, in such a case deemed dividend will be applicable. This is what has been held by Supreme Court. Further, on the issue of whether a HUF can be a shareholder or not, it was observed that on account of explanation 3 to section 222E, a concern includes a shareholder. A concern includes an HUF, right? So friends, Supreme Court's decision held that loan amount is to be assessed as deemed dividend under section 222E. So friends, Apex Court in the case of Gopal and Sons HUF versus CIT held that loan provided to HUF will be deemed dividend even if shares are held by Karta of the HUF, only because Karta and HUF are linked together and there is a specific provision under section 222E wherein loan provided to a concern in which shareholder has a substantial interest, then deemed dividend under section 222E cut start under section 222E will be applicable only because Karta has common holding in the company as well as in the HUF, right? So friends, Apex Court ruling was not in favor of the SSC in the case of Gopal and Sons HUF versus CIT. So friends, this ends the case law. Now friends, the next case law, which is a Gujarat High Court ruling in the case of Mobilia, Bikubai, Ballabhai versus ITO TDS. So here, there is no tax officer as such, you can see. There is a TDS officer over here, and the issue over here is related to deduction of tax, deduction of TDS, correct? And the issue under consideration is whether interest received on enhanced compensation, right? Interest received on enhanced compensation should be taxable as capital gains or income from other sources. So, friends, we have studied under section 56 to 8, clause 8, wherein interest received on enhanced compensation. Compensation is received because your land has been acquired by the government. There has been compulsory acquisition of your land which you were holding, right? And since there is a compulsory acquisition, a compensation is being paid by the government. Now, friends, if there has been delay in paying the compensation, you will receive interest, right? So that is known as interest on enhanced compensation. Interest on compensation, fine. And enhanced compensation is something which, suppose the land value was 50 lakhs and government allotted you only 20 lakhs. So you challenged it, the SSC challenged it, and the SSC received the enhanced compensation of another 30 lakhs. And if SSC is receiving interest on such enhanced compensation, then it is termed as interest on enhanced compensation, and accordingly interest on compensation or interest on enhanced compensation is taxable under section 56 to 8, right, on which you get deduction of 50% under section 57, and the same is taxable on receipt basis under section 145, right? So this is what we have studied, this is what we have discussed for interest on enhanced compensation and interest on compensation received on account of compulsory acquisition of the land. So similar is the case wherein SSC received interest on enhanced compensation. There were two components received. First, enhanced compensation was received by the SSC, and second, interest on the same was received by the SSC. And friends, the assessing officer has denied the application of the SSC, wherein SSC had made an application for nil reduction of taxes. SSC has made an application for nil reduction of taxes on the income which is received from enhanced compensation and interest from enhanced compensation. Assessing officer has rejected this application, wherein it has contended that taxes are liable to be deducted, and accordingly you are not eligible. Accordingly, the SSC is not eligible for nil rate of tax deduction certificate. Correct, friends? So SSC is in front of the Gujarat High Court, wherein once the TDS officer rejected its claim, the SSC filed a writ with the High Court, correct? And we are in front of High Court, wherein what are the observations and what was held by the High Court, we will discuss in the subsequent slides. First of all, let's read out the issue under consideration and facts of the case on your screen. Issue under consideration is interest on enhanced compensation under Section 28 of the Land Acquisition Act. Land Acquisition Act of 1894 has been replaced with Right to Fair Compensation and Transparency on Land Acquisition Act 2013. However, the relevant provisions which are applicable in the Land Acquisition Act also remains applicable in the new Act of 2013. Fine. So is the interest on enhanced compensation accessible as capital gains or income from other sources? Right? Facts of the case: the petitioners' agricultural lands were compulsory acquired for undertaking an irrigation project. So agricultural land has been compulsory acquired. Friends, we will understand that agricultural land, any income thereon, right? If there is compensation, income on agricultural land, the same will be exempted from tax, right? Accordingly, the SSC has filed for a nil rate of deduction of tax, right? And this is what has been rejected by the assessing officer, wherein as per assessing officer, the income is income from other sources and accordingly taxes are deductible, correct? So petitioners agricultural land were compulsory acquired. Accordingly, petitioner challenged the compensation awarded by the collector, which led to award of additional compensation and interest, right? So here enhanced compensation has been received as well as interest on the enhanced compensation has been received by the SSC. The petitioner filed an application in the prescribed form to the assessing officer for issuance of certificate with nil tax declaration deduction at source. So issuance of a certificate, issuance of a nil rate of certificate, wherein tax is not supposed to be deducted. The application was rejected by the assessing officer on the ground that interest amount is taxable at source as per section, correct? So friends, as we have studied that interest on enhanced compensation is taxable under section 56(2)(8), read with 57(1), right? Aggrieved with the rejection of application, the SSC filed a writ before the High Court. The High Court observed that, now friends, what High Court observed that there is distinction between compensation and interest on compensation, right? These are two different components. Enhanced compensation is nothing but a capital gains, and the same should be taxable under the head capital gains, and it will be exempt in the hands of the SSC. It's an altogether different chapter. However, the nature of receipt of enhanced compensation is nothing but capital in nature and accordingly taxable as capital gains. Having said that, interest on enhanced compensation is taxable as income from other sources because it is revenue in nature. So two components and treatment for both of them will be different, right? And interest on enhanced compensation, it can be held that the same taxes are payable. However, On a capital receipt, taxes payable by the assessee could be effectively nil. Correct? So friends, High Court's observations. So friends, in this case, the High Court held that compensation amount, enhanced compensation, which as per Section 28 of Land Acquisition Act, right? Enhanced compensation is nothing but a capital receipt, and accordingly no TDS is liable to be deducted. And interest on enhanced compensation will be taxable as income from other sources. There is no doubt about it, right? So capital receipt is exempt. Income from other sources, which is interest on enhanced compensation, is taxable under the head IFOS, income from other sources. Accordingly, TDS liable to be deducted on capital receipt is nil. However, TDS may be liable to be deducted on interest on enhanced compensation. So, what assessing officer has done in this case is, it has held that TDS is applicable even on the capital receipt. As per assessing officer, as per his view, it was like that enhanced compensation is taxable, and accordingly TDS is also liable to be deducted, and in view of this, assessing officer has denied the nil rate of deduction of tax to the assessee. And to this point, High Court has held that this has been wrongly held by the assessing officer, wherein since enhanced compensation under Section 28 of the Land Acquisition Act is capital receipt and accordingly not taxable, TDS is not liable to be deducted. Correct? So the action of the assessing officer in denying the certificate to the assessee for enhanced compensation is wrong, and accordingly it was held to be in favor of the assessee, wherein since such capital receipt from agricultural land, compulsory acquisition of agricultural land, is not taxable, accordingly TDS is also not deductible. Fine. On screen, the High Court observed that the assessee has received interest under Section 28 of the Land Acquisition Act, which represents this interest under Section 28 represents enhanced value of land and thus partakes the character of compensation and not interest. Correct, friend? So don't go by the word interest under Section 28. Amount paid under Section 28 is nothing but enhanced compensation value. Correct? Hence, interest under Section 28, or we can say payment under Section 28, is liable to be taxed under the head capital gains and not income from other sources. On the other hand, interest under Section 34 of the Land Acquisition Act is for the delay in making payment after compensation amount is determined. Such amount is liable to be taxed under the head income from other sources. So under Section 34, friends, as per Section 34 of the Land Acquisition Act, it is nothing but interest on enhanced compensation, and payment under Section 28 is enhanced compensation paid to the assessee. Payment under Section 28 is accordingly capital receipt, and payment under Section 34 is nothing but interest on enhanced compensation and accordingly a revenue receipt, and the same will be taxable as per Section 56 to 8 read with 57 as per the income tax law. Correct? The High Court held that interest awarded under Section 28, which is the capital receipt, was not liable to tax under the head income from other sources and thus not deductible at source. The Revenue Authority had erred in refusing to grant a certificate under Section 197 to the petitioner for non-deduction of tax at source. So friends, meaning since the capital receipt is not taxable under the head income from other sources, and since the assessing officer has denied the nil rate of TDS certificate to the assessee, action of assessing officer was not correct, and accordingly High Court held in the favor of the assessee in this case, wherein in a nutshell, enhanced compensation being compensation on compulsory acquisition of agricultural land is not taxable. However, interest on the same is specifically taxable under income from other sources, and for that TDS is liable to be deducted only because AO had rejected TDS certificate on the capital receipt. High Court was in favor of the SSC, wherein action of the assessing officer in denying the TDS certificate was disallowed. Correct? So friends, this ends this case law. Now friends, in next case law, which is Kerala High Court ruling in the case of CIT versus Manju and Company 2011 335 ITR 527. In this case, the issue under consideration is whether winnings from lottery by the lottery distributor, whether winnings from lottery in the hands of distributor of lottery tickets can be considered as business income of the SSC or not. So, in this case, the SSC is into distributing of lottery tickets. There were certain unsold tickets in the hands of the distributor, and from this unsold tickets, the SSC has received winnings of the prize money of the lottery. So, whether such winnings can be termed as business income of the SSC, and accordingly expenditure can be claimed on such business income, and accordingly tax liability can be reduced. So, for distributor of lottery ticket, it will be always beneficial for the SSC that the income be treated as business income, and accordingly related expenses can be set off against such a business income against winnings from lotteries, and accordingly the ultimate tax liability can be reduced. Vis-a-vis, if you see winnings from lottery are always taxable at the rate of 30% plus surcharge if applicable plus Health and Education cess under Section 115 BB, and no deduction of Chapter 6A is allowed, no expenditure is allowed to be deducted, no set-off of loss is allowed, no basic exemption limit benefit is also allowed. So, no expenditure is allowed, no deduction under Chapter 6A is allowed, no loss is allowed to be set off, neither the benefit of basic exemption limit is allowed against the winnings from lottery, and they are taxable at a flat rate of 30% as per section 115 BB. So obviously the SSC who has received winnings from lottery ticket will always try to tax it as business income. I mean, the normal person, if you see, cannot be taxed under the head business income because the business of the normal person who has won the lottery cannot be termed as that he is into business of winnings from lottery. However, the distributor of lottery ticket can be termed as into the business of distributing of lottery, and accordingly any income from winnings of lottery, can it be termed as business income or not, is the issue under consideration. Correct, friends? So here, High Court observed that winnings from lottery in the hands of normal person is taxed under Section 115 BB at the rate of 30%. Correct? And in the hands of distributor of lottery ticket, these unsold lottery tickets. I mean, what happens is, suppose 100 lottery tickets are available with the distributor, and out of 100, only 80 tickets are distributed. I mean, there was no buyer for remaining 20 tickets, and accordingly it went unsold, and out of the unsold tickets there was winnings from lottery ticket from such unsold tickets, and the same was claimed by the SSC in this case. So what High Court observed that for these remaining unsold 20 tickets, there is two options with the distributor of lottery tickets. Either they can claim the prize money of the winnings from lottery, or either they are scrap value, they have no value as such, and it can be scrapped. Correct? So either you claim it or either it has no value at all. So in this case, the SSC who is into distribution of lottery ticket claimed the winnings from the lottery ticket, and now the SSC is contending that this is my business income. Correct? And assessing officer has treated this amount as winnings from lottery and taxed it under section 115BB. Correct? And High Court in this case has observed that these unsold units, these unsold 20 tickets will be winnings from lottery for the distributor of lottery tickets, and accordingly this will be irrespective of the nature of income, it will always be taxable under section 115BB. Correct? And also what High Court observed that the person who is distributing the lottery winnings, I mean the lottery prize money distributor, what they are doing is whatever is the winnings, whoever is the winner, whatever is the winnings, they distribute the same after deducting TDS. So accordingly, such lottery prize money distributor also treats such winnings as winning from lottery tickets and not as a business income. Accordingly, based on this observation, High Court held that such winnings from lottery ticket will always be taxable under section 115BB, and it cannot be taxed as a business income of the SSC, because the business income of the SSC is commission received from distributing the lottery ticket and not winnings from lottery ticket. Correct, friends? On your screen, issue under consideration: can winnings from prize money on unsold lottery tickets held by the distributor of lottery tickets be assessed as business income and subject to normal rates of tax instead of the rates prescribed under section 115BB? Correct? So unsold lottery tickets held by the distributor of lottery tickets. High Court's observations: winnings from lottery is included in the definition of income by virtue of section 224(9). Further, in practice, all prizes from unsold tickets of the lotteries shall be the property of the organizing agent. Similarly, all unclaimed prizes shall also be the property of the organizing agent and shall be refunded to the organizing agent. So prizes from unsold tickets are the property of the organizing agent. Also, unclaimed prizes will be property of the organizing agent. Correct? The High Court contended that the receipt from winnings of lottery by the distributor was not on account of any physical or intellectual effort made by him and therefore cannot be said to be income earned by him in business. So, winnings from lottery was not on account of any physical or intellectual effort made by the SSC, so that it can be treated as business income. The said view was taken on the basis that the unsold lottery tickets cease to be stock in trade of the distributor because after the draw, those tickets are unsaleable and have no value except waste paper. Correct? So as we had discussed, one of the scenario as either it can be scrapped or either it can be claimed as winnings from lottery. And in both the cases, once the draw is out, once the numbers are out, such unsold tickets cease to be stock in trade of the distributor of lottery tickets. Hence, the receipt of the prize money is not in his capacity as a lottery distributor, but as a holder of a ticket which won the prize. Correct? Further, the lottery department also does not treat it as business income received by the distributor, but instead treats it as a prize money paid on which taxes are deducted. So as discussed earlier, the lottery department also doesn't treat it as business income because applicable TDS is deducted by the lottery department. It doesn't bifurcate whether the amount has been received by the distributor of lottery ticket or it has been received by another person. Correct? So based on these observations, the High Court has held in favor of the department. Correct? Wherein winnings from lottery won by the distributor of lottery tickets will always be taxable under section 115BB. Nothing will be taxable as business income. Correct? Further, winnings from lotteries are assessable under the special provisions, irrespective of the head under which such income falls. Therefore, even if the argument of the SSC is accepted and the winnings from lottery is taken to be received by him in the course of his business, and as such accessible as business income, this specific provision contained in section 115BB, namely the special rate of tax, will always apply. So specific provision is bound to apply no matter what, whether you treat it as business income or a casual income, it doesn't matter. The winnings from lottery ticket will always be taxable under section 115BB. And separately, also as held earlier, as observed earlier by the High Court, winnings from lottery in the hands of distributor of lottery ticket can never be termed as business income. Correct? And even if it is in the last para that we have just read, even if it is treated as business income, such winnings from lottery will always be taxable under section 115BB. It has overriding effect over all the provisions of the Act, wherein winnings from lottery will always be taxable under the head 115BB, wherein the rate applicable will be 30%, wherein you won't get any deduction of expenditure incurred for winning the lottery, wherein no loss is allowed to be set off, no benefit of basic exemption limit is available. This is coming from section 115BB. Correct, friends? So, High Court's decision. The High Court therefore held that the rate of 30% prescribed under section 115BB is applicable in respect of winnings from lottery received by the distributor. Correct, friends? So, friends, High Court in this case was in favor of the department, wherein winnings from lottery was held taxable as income from other sources, and the rate applicable is as per 115BB. Now the next one is quoting the relevant case law, which is the last of the lot, which is the last of the series of the case law, correct? Wherein quoting the case law in examination, you will be given a specific case, okay, and then you will cut start, and then you will be asked to interpret a provision of the act along with quoting the relevant case law related to that provisions of the act. Fine. So in this case, a similar situation I have tried to put on, wherein the facts of the case are, the situation of the case is MD of a private company holds 50% of its paid up capital of the company. The balance as at 31st March 2019 is in general reserve was 10 lakhs. Correct? The company gave an interest-free loan of 8 lakhs to its employee having salary 10,000 per month, who in turn advanced the said amount of loan so taken from the company to MD. So the loan, which was for the benefit of the employee, was provided by the employee to the managing director of the company, friends. So you can say indirectly the funds have been routed by the company to the person, to the shareholder who has substantial interest in the company. Correct? The AO had treated the amount of advance as deemed dividend. Is the contention of the AO correct or not? We have to determine, we have to explain with reason. So friends, here you can see that section 222E will be applicable, correct? Because indirectly the company has provided loan to the managing director, correct? Because the loan was provided to the employee, and the managing director in this case, you can say, is able to influence the employee, wherein the loan provided to employee is routed to the managing director. So here the person who is holding more than 50% of the paid up share capital of the company, a company can always influence its employees. And here you can see that funds have been routed from the company to the employee, and the employee has provided the funds to the managing director. So this is an indirect way of obtaining the benefit, indirect way of advancing a loan, correct? And this will fall under the clause of wherein advance or loan is provided for the benefit of the shareholder, correct? So this is getting covered as per the provisions of section 222E as well, wherein advance or loan has been provided by the company not having public substantially interested. Such company has provided loan for the benefit of the shareholder in an indirect way, correct? So friends, this is getting covered as per the provisions of section 222E, and also in support of the claim of the assessing officer, you can say, in support of this claim, there is a case law which is held by Apex Court, Apex Court of India in the case of L. Alagasundaram Chettiar in 2001, wherein the facts of the case were similar to the facts of the case law, and Supreme Court in this case held in favor of the department, wherein amount of advance or loan provided indirectly by the company to the managing director of the company was termed as deemed dividend under section 222E. Correct, friends? So, this particular case law, this particular facts are not only getting covered as per the provisions of the Act of 222E, but are also confirmed by the interpretation of Apex Court in the case of L. Alagasundaram Chettiar. Correct, friends? So this case law is in favor of the department. So friends, this concludes the case law series. Okay, thank you.